Right, welcome to Iron Financial, where we forge stronger portfolios by stress testing market weakness. Today, we're putting Conduent, ticker CNDT, on the anvil. And the question we're hammering out is a big one. Is this company actually forging a solid foundation for a long-term hold in your portfolio? Or is what we're seeing just a value trap, one that's teetering on the edge of a complete structural collapse? There are a ton of conflicting signals coming out of their latest earnings report, so let's get right into it and cut through the noise.
Yeah, the market is completely, and I mean completely torn on this one. You look at the stock chart and you see this jump right after their earnings report came out. Now, on the surface, that looks like a big vote of confidence from Wall Street, right? But then you start looking at the raw materials, the actual fundamental numbers inside that report, and you see a much more dangerous and complicated picture. The signals are totally crossed. And you know, that's exactly the kind of environment where disciplined, tough analysis really pays off. Is this just hype, or is there something real being built here? That's the question we have to answer.
And this slide right here, this is the heart of the entire puzzle. This is the contradiction that really defines Conduent today. I mean, how in the world does a company's revenue, their top line, shrink by $134 million? That's a drop of over 4%. Yet at the exact same time, its adjusted profits explode upward by $40 million, a massive 32% gain. It seems to defy financial gravity. So what exactly are we looking at? Is this just some shrewd financial engineering, a temporary illusion cooked up in a spreadsheet? Or is the company truly shedding dead weight to build a leaner, stronger, and ultimately more profitable foundation for the future?
To get to the bottom of that, we need a plan. So, this is our blueprint for today's analysis. First, we're going to dissect that contradiction. Then, we'll look at where they're successfully forging those profits. After that, we'll stress test the cracks that are appearing in their commercial armor. Then, we get to the really ugly stuff, the cash burn and the AI threat, two huge risks to the entire structure. Finally, we'll examine the new CEO's plan to fix it all before we deliver our final Iron Financial verdict. This is how we get to the truth.
Okay, let's get right back to that core conflict because it's so important. Seeing profit growth on top of shrinking revenue, it just feels wrong. It looks suspicious, and frankly, it demands that we grab our tools and drill down deep into these numbers. We have to figure out what's actually holding this structure up, because just looking at the surface, it seems like it's built on a really shaky premise. You can't just ignore a shrinking top line.
Now, management has a narrative, of course. They always do. They're out there telling the world that this is a great story of improved efficiency and smart cost cutting. And that initial pop in the stock price suggests the market, for now, is willing to listen to that story. But here, we don't focus on stories. We analyze blueprints. We look at the load-bearing walls. We check the integrity of the foundation. See, narratives are cheap. Numbers tell the truth. So let's get into those numbers and see what they really say.
So to understand the bull case, to really get why anyone would be optimistic about Conduent right now, you have to look at where the company is successfully forging some strength. We have to give credit where credit is due and actually analyze the pillars that are holding up this turnaround story. Let's start with what's actually working for them.
The primary pillar of that bull argument is right here on this chart. It's a 32.3% year-over-year increase in adjusted EBITDA. Now that's earnings before interest, taxes, depreciation, and amortization. It's a core measure of a company's operating profitability. Jumping from $124 million to $164 million in 1 year is not a small feat. This is a significant, tangible improvement in the company's ability to generate profit from its core operations. And believe me, this is the number that has all the optimists excited.
And this profit growth isn't just a raw number, it's a real sign of structural improvement. The company's adjusted EBITDA margin expanded by 150 basis points. That's 1.5%. What that means in simple terms is for every single dollar of revenue they bring in the door, they are keeping more of it as profit. They are becoming fundamentally more efficient at their core. This isn't some one-off gain. This is margin expansion, and that is an absolutely key ingredient in any successful turnaround story.
So where is that strength coming from? This slide illustrates it perfectly. Look at the new business they're signing, which we measure in annual contract value, or ACV. Think of ACV as a forward-looking indicator of future revenue. The government segment, that big purple slice of the pie, saw new signings just explode by 50%. The transportation segment, there in blue, is up a very solid 14%. These are strong, new, load-bearing beams being put into place. They are winning significant new business in 2 of their 3 core segments, building an engine for future growth, even as the company as a whole is shrinking.
Okay, hold on a second. Hold on. This is all well and good. I get it. Efficiency is great.
New contracts in a couple of areas, that's great too. But let's not lose sight of the bigger picture here. That shrinking top line is a massive blinking red flag. You can't just cut your way to prosperity forever. At some point, you have to actually grow. A building with a shrinking footprint is still a shrinking building, no matter how efficient you make the rooms inside. A shrinking revenue base could eventually undermine the entire structure you're trying so hard to build.
Exactly right. It's time to stress test this foundation. A structure is only as strong as its weakest point, and we need to get in there and examine these revenue cracks very carefully. And that starts with the biggest, most glaring one of all, the deep, undeniable weakness in their commercial business. As we're about to see, that segment isn't just weak, it's actively crumbling.
This slide lays out the problem as clearly as it gets. In the left column, you see the sole growth area, transportation, which is up a respectable 3.9%. Good for them. But the right column? Well, the right column tells the real story. The government segment is basically flat. And then you have their largest single business unit, the commercial segment. Its revenue collapsed by nearly 6%. That one segment is so heavy it's like an anchor that drags the entire company down to a total revenue decline of 4.2%. The part of the business that's supposed to do the heaviest lifting is buckling under the weight.
And look, this isn't just one small crack in the wall. This is significant, systemic corrosion. Let's just break this down. First, revenue is down almost 6%. We know that. But then their pipeline of new business, that ACV metric we just praised in the other segments, is down a disastrous 15% here. So not only is current business shrinking, but future business is shrinking even faster. On top of that, their profitability in this segment is actually getting worse, with margins compressing. And maybe the most damning point of all, 40% of that revenue drop came from their biggest clients, their best customers, doing less business with them. This isn't a small problem. This is a 5-alarm fire in their biggest division.
That fire in the commercial segment is incredibly serious. But it's really a symptom of two even bigger, more dangerous problems. We're not talking about cracks in a wall anymore. These are foundational flaws that threaten to bring the whole building crashing down. Starting with the company's absolute lifeblood, its cash.
And this brings us to what might be the single most critical number in this entire analysis, a negative free cash flow of $130 million. Let's be very, very clear about this. Profit on paper, that adjusted EBITDA we looked at earlier, it means absolutely nothing if you are burning through this much actual, real cash. A company that cannot generate cash cannot survive long-term, full stop. It's the end of the story. They are spending more money just to run the business and maintain their assets than they are bringing in from all their operations. This is the definition of unsustainable.
Let's put this in the simplest terms possible. Forget all the accounting jargon. Free cash flow is the cash left in the drawer at the end of the year. It's the real money you have left over after you've paid all your bills and kept the lights on. It's what you use to pay down debt, to invest in growth, or to return to shareholders. And Conduent's cash drawer isn't just empty, it has an IOU for $130 million sitting in it. That is a catastrophic failure of their business model for the year. It's that serious.
And while they're burning through a mountain of cash, they are also facing a tidal wave of technological change that threatens to wash them away. This is the second major structural threat. And don't take it from us, this is not our analysis. This is a direct quote from their own CEO, Harsha Agadi, who admitted on an earnings call that, and I quote, a rough guess of 15 to 20% of their business is at risk of being made completely obsolete by artificial intelligence. I mean, that is a stunning admission of vulnerability from the person at the top.
And he gets even worse. He calls this risk a moving target, which, let's be honest, is just corporate speak for this number could get a lot bigger, and we honestly don't know by how much. And which segment does he specifically identify as the most vulnerable? You guessed it, the commercial segment. The very same one that's already shrinking, already losing its biggest clients, and already seeing its pipeline of new business dry up. So their biggest business is also their most threatened. This is not some far-off future problem. This is a clear and present danger to their entire business model, and the person in charge is the one sounding the alarm.
Okay, so the problems are clearly defined, and they are severe. You've got crumbling revenue in the core business, a massive cash burn, and an existential threat from AI. So the key question, the only question that matters now, is this. Is there a credible plan to fix this mess? The company has a new CEO, Harsha Agadi, and he's laid out his own blueprint for a complete rebuild. Let's take a look and see if it's actually solid enough to carry the weight of this company.
And here it is. This is the official blueprint for the rebuild. Step 1, increase speed and accountability. Step 2, enforce financial discipline. Step 3, reduce the cost structure. Step 4, optimize the portfolio.
That means deciding which businesses to fix, which ones to sell off, and which ones to grow. And step 5, arguably the most important one, convert their sales pipeline into actual real revenue growth. On paper, it's a solid, logical plan. It seems to address all the key issues we've talked about.
Look, the CEO is certainly saying all the right things. He gets an A+ for messaging, especially targeting strong and durable free cash flow generation. He clearly understands the assignment. But talk is cheap, right? A plan is just a list on a piece of paper until it's executed. Financial discipline and cost reduction are things they've been attempting with mixed results for years. The real challenge is step 4, optimizing the portfolio. That requires making tough, painful decisions about what parts of the business to amputate. And step 5, converting that pipeline to growth, that's the ultimate test. It's easy to say, but it's the one thing they have fundamentally failed to do, especially in their biggest, most important segment.
Which brings us to our final verdict. We've seen the bull case, we've examined all the cracks in the foundation, and we've stared right into the abyss of those existential threats. So now it's time to synthesize the good, the bad, and the very, very ugly, and deliver the clear, actionable takeaway from this whole analysis.
So here is the final breakdown, the final assessment. Let's start with the foundation, the good. The profit engine is being rebuilt, there's no doubt about it. That strong EBITDA growth and margin expansion show they can operate more efficiently, and they are successfully signing solid new business in their government and transportation segments. Now for the cracks, the bad. All of this is happening on top of a crumbling revenue base. The company is shrinking, and that shrinkage is being driven by severe, accelerating weakness in its largest and most important segment, the commercial business. And finally, the demolition risk, the ugly. A massive free cash flow burn of $130 million means the company is financially hemorrhaging. And this is all happening while the CEO openly admits a major portion of their business faces an existential threat from AI.
So what's the verdict? Look, Conduent is the absolute definition of a high-risk, high-reward turnaround story. This is not investment-grade steel that you can just put in your portfolio and forget about for 10 years. This is an active, dangerous construction site. You have a new CEO with a blueprint that honestly looks pretty good on paper, but he's trying to rebuild a skyscraper in the middle of an earthquake, all while the foundation is actively burning through cash. Which leaves us with the ultimate question for any potential investor, the one you have to ask yourself. Is the new architect good enough and fast enough to fix this many deep structural flaws before the entire building comes crashing down? The clock is ticking.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.